Hi everyone, my name is Ruth and I talk about saving and investing in my videos. Today I want to share my approach to investing that has helped me to build my investments to over £50,000. This is a super cost-effective and straightforward way to invest once you understand the main principles. Perhaps you want to start investing but aren't fully sure on how to go about it, in which case you're definitely in the right place. But maybe this video can also help you if you are just curious about the stock market in general and how it might be able to help you get some passive returns. Okay, with that said, there's a lot of different ways that you can invest, but this video covers the method I am using. In a nutshell, my thought process is to keep things straightforward and choose broad, diversified investments with the aim of achieving better long-term results. While I can't tell you exactly what to invest in, I can show you where I choose to invest my own money and my thinking behind it. Throughout this video, I'm going to be mainly using InvestEngine to demonstrate, although the tips still apply if you were to choose a different platform, as they all do work roughly the same nowadays. And on that note, there is actually also a free ebook I have created with the intention of helping people choose their investment platform that I'll have linked in the description of this video. With most platforms, you'll need to go through motions similar to opening an online bank account. You'll start by searching for your chosen platform, which you can usually find online as a website or as a mobile app. Whatever platform you choose, you'll need to provide basic personal information, such as your email, name, date of birth, address, national insurance number, and bank details. The form should take you through it step by step, and once you get to the end, you'll be ready to pick your investments. This is where you could easily get lost, as there are a crazy number of choices out there, but the vast majority of us do get better results when we keep things straightforward and choose from broad, diversified options. Take a look at my InvestEngine account, where I have selected an exchange-traded fund called Invesco FTSE All World. Under details, you can see that this fund allows you to invest in a wide range of companies across the globe and also across different countries and sectors, potentially reducing the risk while participating in broad global market growth. That last bit is crucial for me and my investment approach, because I prefer to invest in globally diversified funds, as I believe in economic growth globally over time, and I don't really see a need to try and outperform the market, which has already averaged around 10% per year over the past 20 or so years. This fund also consists of over 4,000 large and mid-cap companies, meaning a mixture of large and medium sizes. The one I have selected here is accumulating, which means that any income from dividends will automatically be reinvested into the fund. I also like this because it helps me to maximize the amount I have invested without having to take further action, such as manually reinvesting the dividends myself. Look out for the word accumulating rather than income if you want to do this too. And take a look at this chart to see how much of a difference it can make over time. Going back to the fund info page, you can also see here a list of a lot of the companies that are included. It tells us that 60.1% of the fund is categorized as North America and 19% are in the technology sector. This proportion here is going to have a lot of overlap with the S&P 500, which is an index that tracks performance of the 500 leading companies listed on stock exchanges in the US. You might have heard about the S&P 500 as well as the Magnificent Seven because of the impressive returns that they have been making. I like knowing they are covered along with other parts of the world because it gives me some exposure to them without having all of my eggs in one, or maybe I should say 7 analogical baskets. For even more information about a fund, there is usually a downloadable file called Key Investor Information, or fact sheets, that you can look at to find out more things, such as the base currency and any historical performance. You will always find the risk profile is quite high on these, and this is because the stock market fluctuates a lot as values do go both up and down. Don't expect consistent growth any week, month, or year, but the longer you leave it, the greater chance of it snowballing, as you can make money not only on the money that you have invested, but also on the returns from your investments. You won't always find the exact same fund on every single platform, but if you look, you can usually find some with very similar qualities. For example, on Vanguard, I have invested in the accumulating version of the FTSE Global All Cap Index Fund, and on Dodl, I have invested in the HSBC FTSE All World Index Fund accumulation. One final but very important feature to consider are any ongoing charges. Somewhere up to 0.25% is fairly normal for these at the moment, but don't forget that additional charges may apply. Now that we have the investment choices covered, we can go on to actually making the investment and think about the potential returns over time. You'll typically want to open an individual savings account, an ISA, which in the UK currently allows you to invest tax-free up to £20,000 a year. Now that the account is open, I go to the do-it-yourself option to avoid any extra management fees. On most platforms, there will be options for either self-managed or passive options, compared with management or active investments. You can filter options, search, or scroll to find your chosen fund, and once you're happy with the information, you can add it to your portfolio. As long as your percentages all add up to 100%, then you're ready to start investing. Loading up the account with cash is actually really easy because you've already entered your bank details. Click Cash, followed by Add Cash, and you will be prompted to make an instant transfer. For InvestEngine, the minimum is £100 for an initial lump sum. With the cash added, you'll need to go back to the homepage and select your portfolio. It's really important to note that you are only investing the money when you click Invest here. Enter the amount, review the order, and confirm the purchase. Hopefully these steps have helped you to make your first investment. Now you're bound to be on your way to 1 million. Well, not quite, but let's talk about the numbers that might be able to get us there. Assuming we signed up to InvestEngine, did the £100 investment, and perhaps got a welcome bonus like I did, I got £29 for mine, we can then look at past performance to form some estimates. Just know this isn't a guarantee and that your investments can go down as well as up. Starting with £129 in month 1 and assuming an 8% average annual return, similar to what we've seen over the past few decades, I would need to invest £200 extra per month to get to 1 million in just 45 years and 5 months. That might seem a bit ridiculous, but the thing that's really crazy is that only 109,000 of that final sum would have been added by me, while 895,000 would be the total return from investment. The £1 million goal is a bit arbitrary, but you can play about with the numbers using a calculator, such as the one I've linked below, to see where your portfolio could take you. Like here, when I'm starting with £4,000 and investing £300 a month over 35 years to get myself to 300,000. Remember that we can't expect these results to follow this path perfectly. It's more like a guesstimate. And me and my boyfriend have been tracking the growth of our main portfolio since we started investing and found it helps to keep updating the numbers against our own estimates every now and again. That way we know exactly where we stand and can get used to the highs and lows of investing. As of today, in May 2025, my personal investments that started in December 2021 have returned around 7.5% per year on average, after being as high as 15% 5 months ago. This is where having a long-term view is essential, and what really keeps me motivated is knowing that I will let this money compound and grow over time. So to recap, here are my takeaways and actionable recommendations. Keep it simple. Focus on broad, diversified investment options rather than trying to pick individual winners. Understand your platform. While I recommend InvestEngine, the steps for signing up and investing are similar across most platforms. My free ebook in the description can help you choose. Consider accumulating funds. Look for funds that automatically reinvest dividends to maximize your growth over time. Embrace the long-term view. The stock market fluctuates, but consistent investing over time can lead to significant returns due to compounding. Start Start small, stay consistent. Even a modest initial investment and regular contributions can make a huge difference over decades. I hope this video has helped you to understand not just how to start investing, but also why I believe in this approach. If you'd like to get access to my mini course that'll take you step by step through what you need to do to start investing in probably less than an hour, you can sign up for my newsletter where I'll be sharing it free to the first 50 people who sign up. Otherwise, you can expect so much more in the way of saving and investing content through this channel. Thanks so much for watching, guys, and I will see you in the next one.